Hello and welcome to CRISIL's post-budget analysis. I'm Dipti Deshpande, Principal Economist at CRISIL, and I'm joined by Dharmakirti Joshi, Chief Economist, along with Krishnan Sitaraman, Chief Ratings Officer, and Miren Lodha, Senior Director, CRISIL Intelligence. Today, we'll share our quick reactions on the budget announcements. So let us get straight into the analysis. DK, let us start with your inputs on the overall macro takeaways. What would you say is the content or the context of this budget?
Well, I think the budget was framed under very benign domestic macroeconomic scenario where growth was higher than expected and inflation proved to be too benign. And actually, Economic Survey has estimated that the growth potential of the economy has gone up during such uncertain and protectionist environment that is playing out. So that is point number one. I think the other thing to note is that the capital inflows, the currency, that was completely disconnected from the macro environment. And the third point I want to make is that the budget, the GDP assumptions are very critical. Here, GDP is going to undergo a revision by the end of this month, so we'll have a completely overhauled GDP series with rebasing of the series and also methodological changes, so that can change the size and the speed of the economy. So that can also have implications for what the budget is factoring in its calculations. Having said that, I think the budget is not a big bang budget, I think, but it's a number of small announcements which are very critical, and they are aligned to the Viksit Bharat goal of attaining that status by 2047. And here, I think the first and foremost is the fiscal prudence of the budget, which has been the hallmark of the NDA government. And in this budget also, they've managed to reduce the fiscal deficit to 4.3% of GDP. At least that's what they're targeting. And they have achieved all their targets that they set post the pandemic. Now, the budgetary assumptions are also credible and conservative, whether it is tax or the underlying nominal GDP growth, which is assumed at 10%. So I think on the fiscal front, I think it gets full marks. Now, coming to how it intends to support the economy, here I think what one of the wrinkles in India's growth story was that despite a benign macro environment, that we saw capital outflows. To address that issue, what they have done is, I think they have tried to open up the equity markets to Indian nationals abroad and also to foreigners by expanding the caps. And on top of that, they have also tried to attract more durable FDI into the data centers and other new age sectors. So that's how they are trying to encourage capital flows. Second, I think, is that their focus on manufacturing continues, but there is a more refocus on the services sector, particularly for employment generation. For manufacturing, I think they focus on the new age sectors and try to give incentives via reforms, etc. But they have not lost sight of the legacy sectors like textiles, etc., which also they are trying to promote. I think the services is very important because it has been the fastest growing component of GDP, and I think it creates employment in several of its segments. And here the budget has focused on tourism, it has focused on education, it has focused on healthcare. I think these are very labor intensive sectors and many of them suffer skill mismatches. So I think the energy and the resources of the budget are also deployed towards ensuring that the service sector continues to perform well. So I think in this way, the budget has tried to use whatever resources it has and carried out a number of incremental but very important changes to continue the growth momentum that India has witnessed in 25-26.
Thank you. A key lubricant for growth is the financial sector. So, Krishnan, if I may have you join in here, what are the key measures that you believe are the ones that have been announced for the financial sector, and how do you see the impact here on the economy?
Okay, thank you, Dipti, for the question. Just to set the context, in my view, the current union budget has the pivotal theme of long-termism running right through it. Through the budget, the government has conveyed that they are not too flustered by the short-term implications of their measures, but are steadfastly focused on their vision of Viksit Bharat that will ensure long-term stability and sustainability. Now, coming to a specific question, I would say that the financial sector is one of the key pillars of our economy, and today's budget announces a set of measures to strengthen the resilience of the sector and enhance its contribution to economic growth over time. Let me touch upon the key measures here. Firstly, with banks accounting for 3/4 of the incremental credit to the commercial sector, a strong and resilient banking sector is vital for India's growth trajectory towards Viksit Bharat. Now, the proposal to establish a high-level committee to suggest measures towards that end demonstrates the government's commitment to fortifying the banking system, ensuring financial stability, and driving inclusive growth. Next, the proposal to restructure PFC and REC, which together account for around 40% of the overall power financing landscape, marks a significant step towards strengthening public sector NBFCs. Currently, 90% of their financing is focused on the power sector. With this, the lenders could consider exploring opportunities in critical infrastructure sectors beyond power financing, such as transportation, logistics, and data centers. Such diversification would go a long way in helping the government realize its vision of Viksit Bharat, where robust infrastructure financing frameworks will play a key role in the nation's growth trajectory. Then we have the proposed Infrastructure Risk Guarantee Fund, which can strengthen lender and investor confidence by helping them manage construction phase risks, which often constrain infrastructure financing. Prudently calibrated partial credit guarantees, which are envisaged under the fund, can help lower expected loss in under construction projects, which will in turn improve project bankability, crowd in capital, and enable funding access at more private or more competitive costs. Then we have the measures around the TReDS securitization, which will enhance funding access for MSMEs. Now, by enabling securitization of TReDS receivables, the measure directly supports MSME working capital needs through wider access to funding, potentially lowering funding costs and ensuring better liquidity. With more than 2.3 lakh rupees crore of invoices already financed on TReDS in fiscal 25, this measure can create a sizable and standardized pool of short-tenor receivables for capital market investors. Extent of market development will hinge on clarity around origination frameworks, transaction structures, and operational controls. Subject to these enablers, this move is structurally positive for India's securitization market, as well as for MSMEs funding access over the medium term. Next, we have the proposed hike in the Securities Transaction Tax, or STT, on derivatives trading, which the markets don't seem to have taken favorably. But again, long-termism and market stability and sustainability seem to be the key objectives here. I believe this measure is intended to curb speculation and encourage long-term investing. Of course, in the short term, it is set to impact proprietary traders, including high-frequency traders and arbitrators. In addition, there are also measures to deepen the corporate bond market and improve secondary market liquidity, such as a market-making framework and introduction of total return swaps, which should augur well over the long term. Those were then a brief snapshot of the key measures announced for the financial sector in the union budget. That said, the success of these measures will ultimately depend on the effective execution, that is, timely implementation, clear coordination between various parties involved, as well as diligent monitoring. And on that note, I will conclude my overview. Thank you very much. Over to you, Deepti.
Thanks, Krishnan. Miren, if I can bring you in here, public spending, as we know, on infra has remained a much needed constant support to growth for all these years. But the private sector is yet to see in a decisive crowding in. Does this budget, in your view, bring forth any new initiatives to usher in private capex, or broadly, which are the focus areas for infra this year?
Yeah, thanks, Deepti. No, you're right. So I think last few years, especially the post-COVID period, if you see, infra investments have largely been driven by the the budgetary allocations by the government. And this year is no different. I think the focus by the government on infra development, that continues. And this in a way is very critical because if we want to realize our goal of becoming a global manufacturing hub and improve the export potential of some of our key sectors, then I think from a logistic efficiency perspective, I think these investments are critical. The focus this year also is on sectors that can help improve logistic efficiency as well as enable the green transition and thereby improve our manufacturing competitiveness. In terms of allocations towards infrastructure, if you see, in terms of numbers, it's up by a significant 18% compared to last year's revised estimates. The total allocation towards infrastructure is about 11.9 lakh crores. From projects and segment standpoint, I think national highways, the rail freight corridors, solar energy, battery energy storage, and the transmission projects. These are some of the thrust areas in this year's budget. Apart from this, there's also a significant increase in allocations towards the affordable housing schemes, both the PMAY urban as well as the PMAY rural. From here on, I think the imperative will be to move projects from paper to implementation and be able to execute some of these projects at scale and with efficiency. I think this is something which will be absolutely key in helping the government move towards its goal of increasing the share of manufacturing. There's a stated goal of moving from the current, we are roughly at manufacturing is 17% of the GDP right now. The goal is to move to about 25% by 2035. So yeah, I think till the time private investments come in a big way, I think the government continues to do the heavy lifting on the infrastructure side. Over to you, Dipti.
Thanks, Miren. Thank you all for joining in. Thanks, DK, Krishnan, and Miren. Truly appreciate your time and your perspectives. Thanks.
Thank you. Thank you so much.
Thank you.